Hi, I'm Jimmy. In this video, I'm going to look at whether or not it's possible that stock prices are not overvalued despite the fact that we're going on one of the longest bull runs in history. So, for anyone who knows me, well, they know that I tend to let the numbers tell the story. And if you've been a part of our channel at all, well, you'll know that there are two video series that we've been working on right now. We have the Dow 30 analysis that we're just finishing up. And in that series, we've analyzed all 30 companies in the Dow Jones Industrial Average. Then we're just about to present the three different portfolios that we tried to build based on that analysis: a value portfolio, a dividend portfolio, and a growth portfolio. So there are links in the description below to all 30 companies that we did the analysis on if you're interested in them. Then in the next series we're about to start, well, that's our valuation series. And there I intend to go through as many possible ways to calculate the intrinsic value of a stock as we possibly can. We're going to look at when to use each valuation method, and we're going to walk through actual examples of the calculations of the intrinsic value or fair value, whatever you want to call it. We're going to try to do that for virtually all publicly traded companies, or at least as many sectors as we possibly can. So that's coming up. And if that's something that sounds interesting to you, hit the subscribe button because it's going to be a ton of fun. So the reason I bring all that up here is that as I'm going through updating the valuation numbers for all 30 companies that we did in the Dow 30 analysis, well, I'm also prepping the master list for all the different valuation techniques that we want to cover, because I want to be sure to cover as many possible valuation techniques as possible. So if you have any thoughts on unique valuation techniques that you've heard of or you'd like to learn more about, post them in the comments below and I'll be sure I can include them when we begin that series. Well, as I'm trying to come up with the fair value for each of the companies in the Dow as of today, not back when we shot the video, well, I started doing the math, and quite a few of them look like they were trading at a decent value right now. And if we pair that with the fact that I heard Buffett say this:
I think stocks are ridiculously cheap compared, if you believe that you're going to have the 3% interest, 30-year bonds makes sense.
That's a big if, though.
Well, that's what makes going to work interesting.
So that was part of a conversation on CNBC that Buffett had with Bill Gates and Charlie Munger. And both Gates and Munger came to the same conclusion as Buffett. If rates stay low, then stocks look cheap. So how does this work? And how does low interest rates impact our valuation of the Dow 30 companies, or pretty much any company that we were trying to come up with a fair value for? So I'm sure that we all know that generally speaking, the fair value of any stock should be based on its future cash flow. Now, maybe that's cash flow coming in the form of dividends that we collect, or perhaps it's the free cash flow of the company. Then in theory, the company takes that generated free cash flow and they try to grow the business. And as the business grows, well, the business becomes more valuable on the stock market, our shareholder price goes up and everybody wins. So here's a very quick and dirty way of determining the fair value of a stock by discounting the cash flow. And then after we look at this, I'll tie it all together and then we could see if we could determine where we think the stock market will ultimately go. So we have our current cash flow projections for this completely made up company. So maybe this 100 in 2019 is $100 million of free cash flow, or maybe it's a $100 dividend that we expect to receive in this year. Either way, the concept would remain the same. But when I created this spreadsheet, I actually intended on I was thinking free cash flow. So let's just stick with that. So in this example, well, we estimate that this company, this fake company, is going to bring in $100 million in 2019. And then they're going to grow by 15% for 4 years. Then it grows by 12.5% for another 4 years, then 10% for 4 years. And I keep stepping it down every 4 years until we hit our perpetual growth rate of 2.5%. So right here is where we can see the perpetual growth rate. And that growth rate was used to calculate the terminal value, which you may have noticed at the end of all of our projections. So I'll dive more into that when we do our discounted cash flow video. But basically, the perpetual growth rate it comes up with the number that we believe free cash flow in this case will grow by every year forever. By the way, this type of growth is actually called a multi-stage model, where you have different levels of growth based on different time periods. Here we changed it about 6 times, and that's actually a little bit crazy. Usually the way I've seen it done is maybe 2 or 3 times you might change it. But this is a made-up company, so we can do whatever we want with it. Either way, now we have our projected free cash flow, and we're fairly confident in our free cash flow projections. We believe that they're going to be accurate. So now the question is, what is all this future cash flow worth today? And to do that, we must discount each of our projections by our required rate of return. And typically, we would each individually determine our own required rate of return. Generally, we would base the return that we require from our investments. We would base that on maybe our investment goals, our assets, our liabilities, how long we think we're going to be invested for, taxes. We would probably want to account for inflation. We would probably, in theory, want to account for the riskiness of the investment. All of that gives us our required rate of return. So then we discount all of our projected free cash flow numbers by our required return. In this case, we use 7.5%. And then we would account for the debt of the company. We made up the company, so they have no debt. We divide that by the number of shares outstanding, and we end up with the fair value of the stock. In our case, our fair value for this stock is $119 per share. Okay, so all of that is simple enough. But what does this have to do with interest rates? Well, right now, the 10-year US Treasury bond is trading at a yield of about 2.5%. So in our example, well, we assume a required rate of return of 7.5%. Well, we made that decision knowing that if we wanted to, we could have bought the 10-year Treasury bond and we would have gotten 2.5%. And if we hold everything else the same for the moment, well, we can say that really what we determined is that we wanted 5% more than the risk-free rate. And generally speaking, the 10-year US Treasury bond is the default for the risk-free rate. Now, whether or not we believe this is actually true, whether or not it's actually a risk-free rate, well, that's a debate for another time. Let's just assume it is for now. So we know that we want a 5% spread on top of the risk-free rate. Again, I'm oversimplifying this a bit, but the concept holds true. So if we require a return of 7.5%, and we believe that our future projected free cash flow numbers are accurate, well then, if we paid exactly the fair value that we calculated of $119, then our return would be 7.5% a year, which is our required rate of return. That fair value price tells us the price we should pay to collect our 7.5%, of course, assuming the market prices the way we think they should. Now let's pretend that this company is currently trading at $100 per share. Well, since we need 7.5%, that's our required return, and we get that if we pay $119 per share, well, $100 a share looks like a pretty good deal right now. And we might even say that this stock looks ridiculously cheap, to use Buffett's words. So ridiculous is probably a bit of an exaggeration in this particular example, but we get the point. Now this brings us full circle back to interest rates. So what if the 10-year Treasury bond wasn't 2.5%? What if it was 5%? Well, you would never accept a 7.5% return when you get 5% for a risk-free investment. Why would we? So let's imagine we still want a 5% spread on top of the risk-free rate. So now instead of 7.5, now we want a 10% return. So our required return goes up from 7.5 to 10. Well, assuming that everything else with the stock stays exactly the same, nothing else will affect the company. Free cash flow is still projected to be the same thing. There's no debt for this company, so there's no implication with bond yields. So assuming everything else is the same, let's see how it impacts things. So now with just a 2.5% increase in the risk-free rate, well, now the fair value of our stock is just $70 per share. So just like that, our stock loses $49 in value. It was calculated to be $119 before, and now it's just $70. So this is the exact reason that Warren Buffett, Bill Gates, and Charlie Munger would all agree that with low interest rates, well, the stock market can keep moving higher. Now, in the CNBC video I keep referring to, I actually have a link in the description below if you're interested in watching the entire video. Well, they're talking about this because while just a year ago, the US Federal Reserve was talking about raising interest rates, now they're actually talking about keeping them flat for at least a while. And they almost have to keep them, they have to stop raising them because they're worried about an inverted yield curve. I actually have a video on the inverted yield curve if you're interested in learning more about it, link in the description below. But basically, it's a bad sign if the yield curve inverts. So this is the current yield curve as it is right now. And an inverted yield curve would be when longer term rates have lower interest rates than shorter term rates. So it would look something like this red line does. But interestingly, the Federal Reserve doesn't doesn't directly control any of these rates. In fact, they control the Fed funds rate, which is an overnight rate. So that would be at about this time period here. And we can think of this as how much impact they have on each of the time periods. So clearly, the further we get away from the overnight rate, well, the less impact the Federal Reserve has on interest rates. So as they started raising interest rates, well, essentially they were banging up short-term rates while the market kept longer-term rates disproportionately low relative to the short-term rates. So that's why they're going to have trouble raising short-term rates up much more, because if they do, the yield curve might invert further than it has in recent months, and that could be a problem for the economy in general. So when we switch over to the 10-year Treasury bond, well, we can see that Treasury bonds have been falling. And this is important when we're trying to come up with our valuation for our $1.30 stocks, or pretty much any stock that we're looking at. So when we did our previous videos, well, they would have all come in recent months where interest rates were likely higher than they are right now. So when we turn around and we calculate the fair value, when I was calculating it, it turned out that I was using a lower risk-free rate. I didn't realize it, and I was like, wow, why are the valuations coming up higher than I would have expected? And the key driver to that was the lower risk-free rate. Lower risk-free rates leads to a lower required rate of return. Lower required rate of return, higher intrinsic value. So our question is, do we think that interest rates will stay low? And if they do, are they likely to stay that way for at least a while? So if they do, perhaps stocks are not as overvalued as people believe they are. I still think that we need to watch the economic indicators that come out, and I plan on putting together another video on that topic at some point in the near future. But what do you think? Are stocks currently overvalued, fairly valued, or undervalued at this point? If we believe interest rates will stay low, at least for, let's say, the next year or two, well, stocks could be fairly valued, maybe even undervalued. But let me know what you think in the comments below. If you haven't done so already, hit the subscribe button. We got lots of good videos coming out in the near future. If you found this video interesting, hit the thumbs up. Thank you for sticking with me all the way to the end of the video. I'll see you in the next video. Thanks.